Guys, my name is Malcom St. John. I graduated, as Megan said, in 2017 as a political science major, but decided to try my luck at finance and got a job at Citi within their investment banking division in a group called Financial Sponsors. And what we do essentially is we help raise capital for private equity firms looking to buy out companies. So they find a company they like, they come to us for the debt essentially that they use to buy the company. It's been really interesting. I'd love to get a read of, and wait, let me try to, here we go. This is better so I can see you guys. I just want to get a read of the room or whoever's what brings you to the class today? Are you guys interested in pursuing a career in finance? Do you guys have any finance background? That'll kind of help me figure out how to have this time be spent most effectively. So if anyone just wants to, and also we're such a small group at this point, just the four of us. So it'd be great to hear from you guys maybe individually. So Nick, do you mind if we start with you, or Nicholas?
Sure. I plan on majoring in econ,
Cool.
and have an interest in finance too, and I understand the terminology fairly well. So
great.
Yeah.
Great. And Lee, how about you?
Yeah, I'm pursuing a career in investment banking, and I'm also currently an intern in equity research.
Oh, great. And then Mia, last but not least, what about you?
Okay, I was gonna say, I don't know if my camera keeps going out, so I'm not really sure if it's working. But I have done a internship for a mutual fund company, and did a little bit of financial modeling with them. But
cool.
I'm kind of interested in asset management specifically, but I don't have a ton of experience. Just a little bit.
Cool. Okay. No, that's absolutely fine. I mean, we'll cover the basics today, and if you guys want a follow-up session, we could, you guys could spend a little time maybe with the model, the terminology, kind of what you hopefully will, if I do a good job, will have learned today, and then maybe we can schedule another session to kind of go over some of the stuff in more detail. But great. I guess we can get started then. So I will share my screen, and maybe we can just go over. There's no need for you guys to open up anything yet. I just want to go over what we would call like a paper LBO, which is just like back of the envelope, kind of just the bare bone basics of what we're trying to do. So when you go out and buy a company, or when you go out and buy anything, it obviously has a purchase price, right? In the way that purchase price is determined in the acquisition world is it's typically a multiple of EBITDA. And EBITDA is earnings before interest, tax, depreciation, and amortization. And it's a standardized way across the industry to basically compare companies' profitability. It subtracts out decisions made by management for capital structure, which is why it's not including interest or tax, and their capital allocation decisions, which is why it doesn't include depreciation or allocation or amortization. So let's assume that this company, let's just work with small numbers right now. So this company has $40 million of EBITDA, and let's say it's a tech firm, so it has a slightly higher multiple. Let's say the multiple is 10. So, and typically how multiples work is, and yeah, sorry if I spell anything wrong. I'm just trying to go quickly at this point. But yeah, typically how multiples work is the higher growth the industry, and it's usually industry specific. So if you're talking like tech, for example, you're going to have multiples kind of in the low teens, like 11, 12, 13 times EBITDA. Whereas if you're kind of in a more established, slower growing industry, like industrials or something along those lines, you'll see multiples kind of in the 5 or 6 range, and sometimes even lower. So, and the multiple is again just how much you're willing to pay, how many times over their earnings you're willing to pay. So this company and the way you determine a multiple is through comparables, right? So if there was a deal for a similar company done like 6 months ago at 10 times, it's pretty safe to assume that the company's not going to sell for anything less than 10 times, and the purchase price will end up usually being around 10 times earnings. So let's just assume here that this company is worth $400 million, right? So how are we going to pay for that? So the private equity firm, and I'll show you why this is the case in a second, but the private equity firm wants to use as little as their own money as possible. They want to finance it all with debt. If they could finance every single penny of that $400 million with debt, they would. But that's not an option for them. So what they try to do is they try and, hold on. What I'm doing here is we're going to figure out what our sources of capital are and what our uses of capital are. So, same idea as if you went out to dinner with your friends, right? And you all split the bill using Venmo or something, something along those lines, right? So the sources would be each one of you, like, Nick, Lee, Mia, and then the uses would just be the full bill, right? $100 each, 3 of you guys split the bill equally, 33.3 each, right? So that's kind of how you should think about this. But in this scenario, we're just going to say there's sponsor equity, which is like how much money the company's putting down, and then there's debt. And so sponsor equity is essentially how much money the buyer is willing to put down that isn't debt, right? So if you want to relay this back to real life, it's the same. If you went out for dinner and you were paying for something with a credit card as opposed to with just straight cash, and then you'd pay back the credit card kind of at the end of the month, it's the same idea. You don't have kind of the skin in the game, but you have to pay back that debt later on, which is what the private equity firm is also doing. And I'll just I'll stop there. Maybe there's some basic question that I didn't go over that would help you guys kind of put this in perspective. So are there any questions off the bat?
When you were just explaining that like credit card scenario, is that with using the sponsor equity or that's with using debt?
That's with using debt. And there's an important, and it'll make more sense as soon as I will hopefully make more sense as soon as I follow through with this example, but that's with debt. So in a situation where you're having dinner with friends and you just pay cash, straight cash, that's the sponsor equity. Where you're paying with your credit card, that's the debt, because you still have that money basically in your checking account, or you still have that money in your pocket if it's cash, right? But you have to pay it back later. So yeah, does that make sense?
Yeah, that makes sense. Thank you.
So we're going to use $400 million to purchase the company. And actually, let's do this. So as a percentage, you typically see a 30-70 split. That's just like typically what you see in the industry, where the sponsor will put down 30%, and they'll come to banks and ask for them to finance the rest of it with debt. So the sponsor is going to put down 120 million, and then they're going to come to the banks and say, hey, could we please help you? Could we get your help in financing the rest of this with debt, with your $280 million of debt? So what does that look like? So through this example, I just want to show you guys, the basic engines of kind of what a model is trying to do, and what we're trying to do in financial modeling, and the reasons why we put it together, and then kind of the different levers of where growth happens, or where you can pull that lever for growth, and why a private equity firm might only want to use debt as little sponsor equity as possible and use as much debt as possible. And, you know, the engine of this whole model is really the income statement, which is the internal, the performance of the company, right? So, you know, you have revenue down to EBITDA, down to net income, and that's the guts of it. And then everything else is kind of, you know, if you think of that as the Christmas tree, everything else is kind of just ornaments that help point you in the right direction. But that's really the engine. So we can get into that in a second, but I just wanted to show you guys kind of where that engine fits into the broader picture, right? So if we just spread this out and say, we say, yeah, okay, so over the next 5 years, which is typically, you know, your typical investment horizon for an investment, for a private equity investment, how does this company pay down, like how does this company look in terms of their operational performance? Let's assume that, so free cash flow is what the company has available to pay down their debt, right? And just like, I guess to take a step back, and sorry, this is my, you know, it's my first time doing this, you know, trying to explain this to a crowd. So if you guys are confused, if you guys, you know, if I'm moving too fast, if I've missed anything, just feel free to interject and let me know, and I'll try my best to explain it. But just to take a step back, what a private equity firm does and what an LBO is essentially you're buying a company and then you're putting debt on the company's balance sheet. And what that means is, and it's kind of an odd concept and it's hard to wrap your head around, at least it was for me. What you're doing is since you own the asset, since you own the company, you can have that company pay back the debt that you used to buy it with. So for example, if I were to buy a corner store, right? If I were to buy the corner store and say the corner store generated $5 million every single year, if the debt that I bought the corner store with, I could use so since I own the corner store, I own the cash flows as well. So I own the $5 million that it produces after it you know, after it pays all of its employees, after it pays rent, after it pays all of its bills, et cetera. Like whatever's left over is mine essentially, right? And so what I can do is I can use that money to pay back the debt that I used to buy the corner store. And that's essentially what this is doing in simplified terms, right? So if I go out and buy a tech company for $400 million and I finance 70% of it with debt, I have $280 million. Let's say that they generate, I don't know, $30 million of cash flow every year. For the next 5 years, I can use that $30 million to pay down the $280 million of debt that I used to buy. So at the end of the 5 years, I have much less debt, and I'll show you guys how that works in a second. I have much less debt, and my equity value, which is this portion, is much larger. And what that's known as is leveraging returns. That's the reason why they want to use as much debt and as little equity as possible. Because, and I'll show maybe the math. If I show you guys the math, it'll make more sense. So what I'm going to do is BOP stands for beginning of period. So essentially what we're doing is we're creating a waterfall here where, okay, we're starting out with $280 million of debt. And then at the beginning of 2021, you know, the first essentially of 2021, we still have $280 million. But throughout that year, let's say that, oh shit, wait a second. Sorry guys, 1 second. Somebody scheduled a meeting 5 minutes ago, expecting me to be able to join at 7:15. Okay, so at the very at the January 1st, we have $280 million of debt. Let's say, so EBITDA is a good proxy for cash flow, but there's still things that need to be subtracted out of EBITDA to get the true number, or the true cash flow number that is basically free cash flow to the company that like you can use to do whatever you want. You can use that to pay down debt. You can use that to reinvest into equipment. You can do that. You can hire more people. So let's say that 75% of EBITDA is converted into cash flow. And so, and the assumption here is that I'm using all of that to pay down my debt. 2022, the same thing. I'm starting with 250 because I generated $30 million of free cash flow, and I'm paying down my debt using that $30 million. And I'm just going to assume that year over year, their revenue stays the exact same, EBITDA stays the exact same, and free cash flow stays the exact same. So it's a zero. I mean, this is a very conservative approach, but it's a 0% growth industry, which is, this is just for, that never happens in real life, but this is just for, our purposes. So same thing. So over 3 years, you can see that, I've generated $90 million of free cash flow, and I've been able to pay the same amount down in debt, right? So my cash flow is now down to my debt number is now down to 190 million. Let's just carry that out for the next 2 years. And now this is a hypothetical sale, but at the end of 2025, if I were to sell, I only have $130 million of debt left from the 280 million that I started with, right? So why does that matter? So let's do one more waterfall here. So the sponsor equity that I started with is 120 million, right? The debt that I started with is 280 million. That makes up 400. But let's see how that changes over time, right? So this is the money, the sponsor equity is the money that the sponsor, the private equity, and by the way, sponsor and private equity firm, those two words are interchangeable. They mean the exact same thing. So sorry if that was confusing, but that means the exact same thing. So actually, let's do this. So since we're assuming that there's zero growth on the business, and let's assume that it also sells for 10 times, the total enterprise value is going to remain the exact same, right? Because if my EBITDA doesn't change from 40 million and my multiple doesn't change from 40 million, it's going to remain the exact same throughout the projection period, right? But let's see how this changes. So 250. But now my equity portion is growing, right? My equity portion is growing because if at the end of if in 2025 I sell for $400 million and I only have $130 million of debt, my equity portion has grown because the capital structure has changed from being debt heavy to equity heavy. So essentially, the way to think about it is the private equity firm only owns $120 million worth of the $400 million company, right? So if the company defaulted or went out of business, the debt holders would have claim on basically 70% of the business's assets, property, whatever, to repay the debt that they have. But as you pay back the debt holders, that equity value portion of the company that the private equity firm owns becomes larger and larger and larger. So let's play around with this a little bit. So money to sponsor, and then internal rate of return. And internal rate of return, or IRR, is it's how profitable the investment has been for the private equity firm. So this is more like money in, out. sponsor. So this is like money that the sponsor is paying for the company, and then it's money that is given back to the sponsor through an exit, which is them selling the company after 5 years, right? So they're having to spend 120 million, right, up front. That makes sense because that's 30% of the total price that they're not using debt to fuel. Zero, they don't get any money here. They don't get any money here because all the money that's being generated is being used to pay down debt, and they're not selling the company. So the private equity firm doesn't get any money. But then let's assume that they sell in 2025. So if they sell in 2025, they receive $270 million because that is how much they, that is how big their equity portion of the capital structure has become. Also, if you guys have any Excel related questions or anything like that, just let me know. I know you guys had a Excel tutorial before this, but you know, if you have any questions on any of this, let me know. Or if you have any questions from that session as well that have popped up since, I'm happy to take a stab. Okay, so 18%. Usually the acceptable threshold is around 20%. 18 is generally fine, but usually the acceptable threshold is about 20%. So how are we going to get that up to 20%? Does anyone know? Anyone have any ideas? What does a private equity firm want to do in terms of the debt / sponsor equity, like percentage of how they pay for the company? They want to use as much debt and as little equity as possible, right? So let's see what that looks like. So let's say they use 80-20. So now the internal rate of return has gone up to 23. Now it's gone up to 37. So the reason why that happens is because you're starting with a smaller number, and even though that you'll see the difference between these two is generally the same, and it adds up to the amount of free cash flow. Because the difference between like a company paying you these $30 million installments each year versus you just getting it all at once, it's, you know, you're still generating the same amount of capital. But the reason why they want to use as little equity as possible is because the difference between 1 and 2 is much larger than the difference between 99 and 100, even though the delta is the same, right? It's still just an increase of 1. But you know, from 1 to 2, you're increasing by 100% as opposed to just 1% from 99 to 100. So that's the reason why they want to spend as little money of their own as possible versus the amount of debt. And also that allows them, say they have a $5 billion fund, that allows them to spread out their capital to many more companies as opposed to just, you know, if they only put down their own capital and didn't use debt, then they would have to focus on fewer companies as opposed to diversify their portfolio and at the end of the day make more money for their investors. So this is really the important part of what drives the model, because this is the company. This is what the company is generating from business. This is how they're operating. You know, the private equity firm comes in and they make operational changes to make that free cash, or just to improve free cash flow generation. And you know, I think private equity firms get a bad rep for a good reason, because they come in and they fire people and they try to increase margins, and it's more of a short-term view of the business. But at the same time, they take a company that may have been a little bit lagging in terms of, essentially they trim the fat and they set the company up for long-term success. So, they hire consultants, they complete tack-on acquisitions to make the company more competitive. So you'll see something like, okay, 30, 45, 50, 55, 65, right? So an increase because the sponsor says, look, within the first year, we can cut a lot of redundancies or a lot of things that overlap with one another and save $15 million on some of the expenses, right? We can move headquarters to a cheaper headquarters. We can, you know, increase pricing in line with the market. We can do a variety of different things that sponsors are really, really good at. Private equity firms are really, really good at because, you know, they have whole portfolios of these companies. They've done it before. So they can really optimize the performance of a fund. So does anyone have any questions on this? Because we're going to, if not, we can go over to the larger model and kind of walk through that. But this is a good, I think this is what's called a paper LBO. This like hits all the basic concepts of how, and this is why I mean, actually, Mia, outside of I think you were the one who did equity research, right? So equity research is more concerned with what's called EPS, which is earnings per share. So you're modeling to get down to net income and then doing earnings per however many shares they have outstanding. But this is typically why you model. You model to figure out how much cash flow is available for the repayment of debt and how much debt a company can handle. I mean, that's generally why you put together a financial model. Does anyone have any questions? No, all set.
You're doing
Can
good.
we move on? What's that?
You're doing good.
Thanks, man. Appreciate it. So did you guys have a chance to look over this at all? I think Megan sent this out earlier. Anyone? Yeah, cool. So are there any questions off the bat when you guys went through it? Do you guys understand what's going on? I mean, I know this is at least to me, when I first started, I took a look at this and I was like, shit, I mean, this is the most intricate web of a bunch of numbers that I don't understand of all time. How am I ever going to untangle this? You know, I think the best way is just to kind of go through cell by cell, and it's incredibly tedious. But, you know, I think if you put it in context of what it represents, it's slightly more interesting. But yeah, if you just go cell by cell and understand how they connect with each other, this stops being like a complicated web of numbers and it starts representing something tangible, something that you can actually, you know, picture in the news or, you know, an actual company's performance. So do you guys have any questions off the bat? Otherwise, I will start from the top. All right. So we're not really departing from, and hold on one second. Just need to check my email. Okay. So the top, does everyone have it open? Yeah. So the top, or I guess you can just look at my screen. This top section, assumptions, is exactly what it is. It's just assumptions, right? So you have the purchase date, which kind of sets the various different kind of year by year sections down there. The current share price. So we're assuming that this is a public company that we're going to take private, right? So the way that we calculate, we need to buy out all the shares that are owned by public shareholders. So we need to say, okay, say Lee owns a share of this company. Let's just say it's called Target, right? Lee owns a share of this company at $28, and that's what it's currently trading at. Lee's probably not going to sell that share to a buyer unless they come with a premium. So you're not going to want to sell. I mean, you're not going to come and just sell it for market, right? Because that just doesn't make any sense. You're waiting for it to appreciate. You're thinking that it's going to do better, which is why you actually, why you bought the stock in the first place. And so you need to pay a premium. So, and this is kind of where investment banking advisory comes in. We say, hey, look, based on other deals done in the space, we would say that the deal is executable on a, I don't know, let's say 25, yeah, okay, this is 25% premium of the current stock price. So Lee's not going to sell his share unless we tack on a 25% premium, which is right here, right? So that's $40 a share. So that's what that is. The LBO assumptions here, we'll get into the debt, but this is essentially just how we price the debt, right? So that from here, so this $360 million, I mean, whatever the number is, but this debt portion here, you have to pay for it, right? Like, it's like if you were not to pay off your credit card every month, you'd have to pay interest. It's the exact same thing. And there are different tranches of debt. So you have the revolver, which is the very top tranche, which is the most secure. And so it demands the least, it's the least expensive. And then you have various different capital structures, but you typically have senior secured and then senior unsecured. So senior secured is typically secured by, or always secured by, collateral. So say, going back to the corner store example, say they have like a state-of-the-art fridge system. You could secure a loan against the value of that fridge system, right? Because that's property. Or you could secure a loan against their accounts receivable, right? Because that's basically money in the bank. And then senior unsecured is it's more senior in the capital structure, but it's not secured by any property. It's not secured by any tangible hard assets, right? So that's the most expensive because it's the most risky. And so essentially, we can get down to that part eventually, but essentially that's how much that part of the capital structure costs, right? You have your revolver interest expense at 5%, and the various different tranches are also here, right? So you have the term loan, which is that senior secured debt that I was talking about, and that is 7.5% a year, right? So every year you're gonna have to pay 7.5% on the outstanding balance. And then senior notes, which is senior unsecured, so it's not secured by any tangible hard asset. That's going to be 10% a year. So, and then the entry and exit multiple, exactly the way we discussed, right? It's 8 times EBITDA, and we're not assuming any multiple growth. So we're going to exit in 5 years the exact same multiple that we came into. And then circ is just, since it's a circular model. And I'll show you where it's circular, but like sometimes it gets busted. And so you just have to set that to 0, and it sets interest expense to 0, and it kind of resets the whole model. So yeah, this is the capital structure that we're assuming this transaction is done with. So you have, and leverage is another important factor. It's essentially like, okay, how much debt can we put in? And it really varies from industry to industry. It's how much debt can we put on this company's balance sheet? How much money do we think they will generate year over year where they can handle 6 times earnings, right? So right now we're assuming that this company can handle 6 times as much debt as their EBITDA. So they'll have to, if they were to pay off all of their debt, it would take 6 straight years without any other capital expenditure, any other free cash flow use. I'll stop there. I think what we do during this session, and let me know if you guys agree, is we just go over the income statement and how, because it's the simplest, but it's also the most important part of the model, because it drives everything else, right? This will summarize the company's performance in a nutshell. And then you have the different cases, right? You have the sponsor case, which is typically the most aggressive. You're assuming that it's growing the quickest. You have the base case, which is what you expect to happen. And then you have the downside case, which, COVID, for example, or something along those lines, that, just something shitty happens. So and that's what's called sensitizing the model, right? So you can go through and you can create, nobody's ever going to be sure about any of these assumptions because they're all future projections, right? So if you have a good sensitization, it's more of just like a goalpost, right? You want to figure out if things go wrong or if things go right, where will I kind of end up on either side of that equation? So I'll stop there. Does anybody have any questions? Anybody want to take this conversation in a certain direction? No? All right, so I'll continue. I'll just do the sources and uses because this kind of sets up the whole transaction, and then we can go into the income statement. But So in terms of, so I was talking before about the stock price and the premium that's added on to the stock price, right? Because Lee's not going to sell his shares for what it's trading at. He's going to want more than that because he bought the stock thinking that it would appreciate. He thought he would, thought he'd make money on it. So I need to spend a little bit more to buy out the existing shareholders, right? So let's say it's trading at 32. I need to apply 25% premium, and so my acquisition stock price is going to be $40 a share. Say there are $40 million or 40 million shares outstanding that I need to go into the public markets and buy. And so this company is worth $1.6 billion, and that's a very common. So this number here is what you'll see is market cap, right? This is the company's market cap. I mean, outside of the premium. The premium is something that we're introducing as part of the transaction, but outstanding shares multiplied by share price, that's how you get market cap. And then you add in debt to get the total transaction value. So this transaction is currently valued at $2 billion. And that's including the debt because you have to refinance the existing debt. So then you have the sources and uses from what we had before, right? So you have the purchase of target equity, which is the market cap plus the premium that you've added on to the individual share prices. You have to refinance the existing debt. And so the reason why there's a difference between this number and this number is that this number is just subtracting out cash. So it's just this minus existing cash, because you can think of debt as, or you can think of cash as negative debt. You can think of debt as negative cash. It's just any cash that's existing on balance sheet, you can just subtract out of the debt number. And then you have your financing fees. So these are the fees that end up going to the bank. So you have financing fees of $47 million. So, I mean, that's incredibly high. That would never really happen. That'd be nice if it happened, but it doesn't. But you have these upfront fees, right? So you're getting the bank together and saying, hey, for underwriting the deal, we're going to pay you an upfront fee. So it's in addition to the interest that's paid every year, but you're basically getting like 7% upfront on the total debt amount. So that's what this is implying here. And then you have an M&A fee, which is you hired a bank to help you sell the asset. You need to pay them a percentage point of the total transaction value. So this is what sets up your sources and uses. And basically, this is just a way to show that, I mean, very similar, identical to the example that we just did. If you guys go out to dinner and the total bill is $100 and you split it 3 ways, the sources are going to be the 3-way split. So it'd be Lee, Mia, and did we lose? Oh no, we got Nick. And then the uses would just be the total bill, right? So this is how much needs to be spent to complete the transaction. How are we going to finance that? All right, we have the cash on the balance sheet. So we have cash. The existing company has $75 million of cash on the balance sheet that we can use. We have a new term loan, so that's the senior secured debt. We have a new issuance of senior notes, which is the senior unsecured debt. And then we have the sponsor, the private equity firm, coming in with their contribution of $563 million. And that's usually just a plug. That's usually just saying, okay, what's left over after we put as much debt as we possibly can? Whatever's left over is what the company or what the sponsor or private equity firm pays. And so again, it's anywhere between 20 and 35%. The lower the better in terms of generating return for the private equity firm, but it's usually around 20 to 35%. So once we have all of that sorted out, let's go down into our income statement. So for this company, we're basically assuming, and let's just do a quick. So this company is growing at around 5-6%. So it's slightly outperforming GDP. So it's this isn't a crazy grower. It's not a crazy grower, but it's it's something that's steady, that generates cash flow, that this is probably, I don't know, an industrials company, or something that's a little more established and not so sexy of an industry like tech or marketing or whatever. So we can assume various different cases here, right? So right now we have the sponsor case on, which is the more aggressive case. Let's say that this case assumes that they complete an acquisition in 2022 that they've been eyeing, that helps increase sales by, I don't know, 7% year over year. It assumes probably higher GDP growth. The economy as a whole is growing pretty quickly. It assumes things that, it basically assumes everything goes right? All their cost cutting goes exactly as planned. It's the best possible scenario, right? Then we have our base case. So in the way you toggle this is just one, you just change the number. So 1 is the base case, or 1 is the sponsor case, 2 is the base case, and then 3 is the downside case. So then you have the base case, which is allowing a little bit of leniency. It's assuming like a haircut on what, assuming that things don't all go perfect. What happens if 30, what happens if 70%? So what happens if 30% of the cost cutting doesn't go as planned, and you only realize 70% of what are called synergies, right? Or what happens if there's a slight downturn in 2022 and 2023 to the overall economy, and it slows, a sinking ship, or a rising tide rises all ships. The opposite of that. What happens if this company has to exist in a slow GDP growth environment? And then you have your downside case, which is essentially assuming everything goes to shit, right? You're essentially assuming negative GDP growth rates. You're not assuming anything as bad as coronavirus, obviously, but you're assuming things within realm of possibility, right? You're assuming the company, China tariffs, like they become a huge headache for this company, and they have to pay these massive tariffs to be able to import some of the raw material they need to create the product that they sell. It assumes that a lot of what could go wrong does go wrong. So you're setting up that other end of the goalpost, right? You're trying to figure out what that band is in which the company can operate, and you can still make money on the investment. And that helps you basically understand what the risk is associated with the company. And this is the interesting part of modeling. I mean, financial modeling is just putting a bunch of numbers together and spitting out other numbers. I mean, it doesn't mean anything unless the numbers and assumptions that go in are well thought out and well researched. And so this is where, you're spending a lot of time in the filings, you're spending a lot of time reading equity research, you're spending a lot of time talking to company management, and you're trying to understand the business from the ground up, right? And these drivers are incredibly basic, just assuming, revenue growth as a single line item is just going to grow 5% every year or 6% every year. You typically have, any given company has like 15 to 20 to 25 sometimes different revenue categorizations, right? And some grow at 15% a year, some grow at 5% a year, some even, decline 15, 20, 30% a year if they're trying to divest or move away from that business segment, So you can really get super granular with how you're building these models up. And that's where that's the intellectually stimulating part of this. That's what's really interesting. That's why, I enjoy my job, because you're able to really interact and get under the hood on some of these companies and understand what makes them tick. So, this again is a very kind of reduced version of what you would see in a typical model, but it's good for just teaching purposes, because these are all the major drivers. As soon as you get really granular, and you're able, you basically build up to a blended average revenue growth, all of those different segments added up together, right? And what does that drive? So that drives, this is pretty basic. I mean, this is just, it's the most important part of the model, but it's the most to a degree, basic version of the model, because it's just taking revenue, it's taking your top line, and it's subtracting out costs, right? And so each one of these items is just subtracting out. So you go from revenue to gross profit to EBITDA to EBIT or EBT to net income. And at each level, you're subtracting out a different cost until you have what's left over, right? And so we can go each one. So you start with revenue, which is your top line, and it's just how much money is coming in the door before any costs, right? COGS, which stands for cost of goods sold. That's essentially how much money it takes to produce this thing that you're selling. So if you're selling, I don't know, if you're selling LaCroix, right? You're selling LaCroix. How much does it cost to buy the can? How much does it cost to paint the outside? How much does it cost to fill it up with the product that you're drinking, right? That's all COGS. And then SG&A is how much does it cost to pay the administrators that help run the whole operation, right? How much does it pay? How much does rent cost? How much does, you guys get the picture. How much does rent cost? How much, and they're typically fixed costs, right? They're typically things that don't vary, because like if you think about it, it doesn't really matter how many cans LaCroix you sell, the rent is still going to be the same on your factory. The people that you employ, unless you fire them, they're still going to be on the payroll. They're still going to demand their salaries at the end of the year, right? So SG&A is typically very static, unless you make cost-cutting moves, whereas COGS moves with revenue. So the more revenue that I sell, the more that I sell, the more revenue I generate. My COGS is typically very tied to that, whereas SG&A is a little bit flatter. It's a little bit, at least businesses that you want for private equity, SG&A stays flat. But as the company grows, you need to buy new plants, you need to pay more people, so that's why you see a slight increase here. Depreciation and amortization, those are, I guess the easiest way to explain that is those are accounting principles, right? It's basically just saying capital expenditure is how much I spend on plants, property, and equipment. So if I bought, that fridge in the corner store example, I wouldn't have to report that all in 1 year. I could capitalize that throughout 5 years or 6 years or however long the life of that piece of equipment I'm assuming is, right? So if it's $100,000, I don't have to say, oh, I spent $100,000 in year one and then nothing in year two. I could say, since it's useful for 4 years, let's assume, I can say in year one, I spent $25,000. In year two, I spent $25,000, et cetera, until, I've depreciated the entire cost of whatever that is. So an amortization is the exact same idea, just with intangible assets. So things that, things like trademarks, things like, licenses, things like that. So this is just subtracting out those two items to get EBIT, which is earnings before interest and tax. And then you're subtracting out, this is kind of an unnecessary line item. This is, don't focus on the other non-operating. That's, but anyway, then you get interest, right? And interest is how much you're having to pay now that there's all this debt on the company's balance sheet, right? So it's quite a lot, right? It's $127 million your first year, which gives you negative net income. But as you pay down that debt and your interest expense gets smaller because that debt amount is smaller, you'll see they start to emerge into positive EBT and positive net income pretty quickly, right? And that's a good sign for cash flow. So let's go into the last thing I'll do is just go into cash flow quickly, and then we can hopefully make this a little more interactive and you can ask me questions. But you'll see. So it goes from net income. So you add back depreciation and amortization because those aren't cash charges. Those are kind of an imaginary accounting, some guy at one point decided that you could capitalize CapEx. So those aren't actual cash charges. And then, so once you add back depreciation and amortization from net income, you have your funds from operation, or your funds, funds from operations is a fine way to put it. Working capital is essentially, I mean, this might be a little too in-depth for this session, but working capital is essentially how much it costs to run a company day to day. It's things like, it's things like accounts payable. It's things like your payroll. It's things like, just things that you need to finance on a day-to-day basis. And you subtract that out of free cash flow. And then you also, so I didn't put this part of the model together. I actually took this from something else. This isn't totally the way I'd like to show it, but you're basically saying, because it feeds from net income, so you can kind of figure out how the waterfall works. But essentially, as interest decreases, you get a larger free cash flow number. So all of this positive free cash flow is going to be spent repaying debt, right? And so the quicker you can get that debt off of your books, and the quicker you can increase revenue, and the quicker that you can increase free cash flow, the quicker that you can increase revenue, the quicker that you can get debt off your books, the quicker you can increase free cash flow and pay down that debt, right? So it's circular in that sense. So yeah, I'm gonna stop there. Hopefully I've done a good enough job explaining this. You've absorbed some of it, and either you have questions now, or you can reach out with questions later. If not, I'm also happy to keep going if you guys are interested if this is helpful and you guys are interested in going through until the very end. But anyway, I'll open it up to questions right now because I feel like I've covered quite a bit, and it'd be good to hear from you guys. All right, so I will start with a question then to you guys. Let's see. So what is the line item called, or what is used to pay down debt? What do we use to pay down debt? Like how do we get from revenue down to what I'm asking about? Is it EBITDA? Is it net income? Is it free cash flow? Yeah.
Free cash flow.
Yeah. So free cash flow is essentially what we get after we subtract out everything, and it's what is left to the company to do whatever they want with. So in this case, we're assuming they pay down their debt, right? Why do we want, as a private equity firm, why would we want the company to pay down their debt? What does that do for us?
It changes the capital structure to where the company has more equity in the company.
Right.
They purchase.
Right. That's right. So when they sell, they don't have to refinance as much debt, and they have a larger chunk of that equity. So what's the purpose, Nick? I'm going to pick on you. What's the purpose of the three cases? And what's the idea behind sensitizing the model?
I'm not totally sure.
No problem.
I'm only a freshman. I think the other two are upperclassmen. I didn't get the sheet beforehand, so I'm a little.
Oh, no problem. Yeah, sorry about that, man. It's
no, you're good.
It's a lot to get thrown at you all at once. So it's good that you're familiar, or like exposing yourself to this early, because I think it takes a little while to really understand what's going on. Mia, what do you think? Do you want me to repeat the question?
Yeah, I was gonna just ask if you'd repeat it.
No problem. So what's the purpose of sensitizing the model? So like we create three different cases, right? Why do we want to do that?
I mean, kind of back to what you were saying initially about the model not really being beneficial if there's not the right amount of research, like in terms of having different options, like you have to know, like you can't predict it all realistically to be one case, like to be one example. Like there are a lot of things that could, factors that could change it. So it's good to like have an idea of what some of your options would be.
Right. That's absolutely right. Yeah, it's just creating margin for error, right? It's creating. You're not trying to hit the bullseye on the target. You're just trying to define the target itself, right? So that's absolutely right. So this is just the debt schedule. So all this does is it shows where how much debt you have initially, and then where the cash comes from to pay it down, right? And it's just a waterfall. It basically says, okay, the revolver gets paid down first, the term loan gets paid down second, and then if there's no call protection on the notes, they get paid down third, right? So it just basically shows that waterfall. It's a relatively, I mean, the numbers are confusing, and kind of how it connects with the other line items can be a little bit intricate, but like in terms of if you take a step back and think about it conceptually, it's relatively simple. It's just basically saying, okay, I'm starting with, if I have $1,000 of debt on my credit card, like how am I going to pay that down? Like, and so it shows the various different stages of repayment. I think it probably makes a little more sense for you guys to go through this on your own, because and I can answer any questions if you guys want after, kind of via email, or we can even have another session if you guys want. But it makes going line by line, I don't think would be the best use of any of our times, and I think it would make a lot more sense for you guys to take the time to understand kind of how this connects. And I don't know if you have access to Excel, because I know they have, I would assume through Colorado College you guys get a subscription, but yeah, if you just tab through this and kind of understand how they connect with each other, maybe you can shoot me a question if you have any, or we can set up another session. But essentially, as you pay down this debt, right? Let's see if there's a total. Yeah. So you start. It's actually, since I think we're on the downside case, right? Yeah, we're on the downside case. So not that much debt is getting paid back. Okay, this is a better example. So right now we're on and just to actually show you guys, sorry, I keep moving around quickly, but let's just take a look at this total debt, or this beginning balance of the total debt, right? So you're starting, ending balance here. This is a better example. So you're starting with $1.5 billion of total debt, right? That's what the private equity company was able to raise in terms of buying out the company, and they were able to put $1.5 billion of debt on the company's balance sheet. Through free cash flow, they're able to pay down almost $1 billion of that debt, right? Almost $1 billion of that debt. So that's the rosy kind of blue sky, everything's great scenario. Let's go to the scenario that we expect to happen, given that we don't expect everything to go perfectly as planned. So they start with 1.5. Oh, they don't quite get as much repayment, right? So the sponsor equity stake isn't quite as big as it would have been if they had actually generated the cash flow that was expected in the sponsor case. And then, as you'd expect for the downside case, repayment is much lower, right? You're only repaying about 200 million, less than that, right? So let's stick with the base case for now. And then at the very end, when you're ready, after 5 years of holding on to this company and making all the changes that you've wanted to make to it, and improving the way it works, and making it more efficient, you want to sell the company. And really the point of a private equity firm, the reason why they exist, is to buy a company at a lower price than you end up selling it 5, 6, 7 years later. and that's how they generate returns for their investors, who are typically mutual funds, teachers, pensions, things like that. And this is just showing that, right? So you have the initial sponsor equity contribution, which is just the cash that the private equity firm, had to shell out in the first place that wasn't covered by debt, right? So day one, the company or the sponsor had to put down $563 million. You have what they are assuming. So basically, you've projected out EBITDA to year 5, right? EBITDA is projected to be about $320 million in year 5. If we're assuming the exact same exit multiple, or the exact same multiple that we did at entry, the company has now gone up in value from $2 billion, which we calculated here, to 2.55 or 2.6 billion. Right. So 5 years later, it's appreciated by about $600 million. And that's all because we've increased earnings. And then you subtract out debt, because essentially the capital structure is, so this is debt plus equity. It's the entire capital structure. And then if you subtract out debt, you get your equity value. And this is what the sponsor is going to leave with, right? Which is a pretty large increase. You go in with 563 million, and then you leave with about 1.7 billion. So it's a very large increase in 5 years. And these are the two return metrics that you look at. So IRR is your internal rate of return, and that's sensitive to time, right? So if this took 10 years to do, so 10 years to increase it about 3 times, this IRR would be much lower. But MOIC, which is multiple uninvested capital, is not time sensitive. So if you did this, if it took 10 years to do that, and MOIC is just essentially, okay, like how many times over did I make my money back, right? It's essentially saying, I sold the company for $1.7 billion. How much does that divide into what I initially put in? And this is how performance is measured. And this is essentially what you're looking at from a private, like if you're a private equity firm, this is the number that you're getting down to. You're saying, okay, all the research that I did, all of this work, I'm only interested in one number really. And it's this IRR number and whether or not it meets our return parameters. And typically the acceptable level of return is around 18 onwards. Obviously you want the higher the better, but it's about 18% is where it starts not looking as attractive. So, let's say things don't go as well. The economy contracts, they screw up some of the integration. Damn, that IRR is much lower, right? Now it doesn't look like such a good deal. So you as a private equity firm, you really have to weigh whether or not there's a likely
I think Malcolm just froze. Let's give it a minute and see if he comes back.
Hey, can you guys hear me?
Yes, we hear you now.
The downside is mitigated by, trust in the management team. It's mitigated by, a resilient industry that is counter-cyclical or not cyclical at all, right? Like if there's a downturn in the broader economy, like is revenue or demand for this product just going to completely dry up? If the answer is yes, maybe that downside risk isn't as tolerable, right? You want something that has limited downside risk. Like for example, we just did a deal for Shutterfly. Apollo bought Shutterfly, which is the photo, the photo, I guess the best way to put it is like they just take your photos, they put it into picture books, they put them on the mugs, they put them on the keychains. You know, that's a very cyclical business. You know, we were surprised that they did that, and now I think they're somewhat regretting it, right? As soon as you don't have money to, as soon as all your money is going to paying rent and paying the grocery bill, you don't have any left. You don't have any money left over to spend on what are sometimes seen as frivolous goods, right? As like a keychain or something like that. So you want something you want a product that kind of stands, that can withstand an economic downturn, that has inelastic demand where people really need that product, right? So that's what makes downside more tolerable. Then you want upside too. You want there to be, you know, you want there to be an ability for the company to capture a larger portion of the total addressable market, right? So in healthcare, for example, biotech is growing at 6 or 7, or even high, almost approaching 10% a year. You want a company that is taking a lot of market share, but also part of a market that is growing really quickly, right? So that's the upside that you also want to invest in. So, you know, it's interesting to see. I'm not on the investment side. I'm more on the diligencing and providing debt, but you really have to understand kind of some of the considerations that go into private equity kind of committees when they're deciding where to invest their money. And so I you know, that part of the job I find interesting. And again, like, these are all just numbers on a page, but if you familiarize yourself enough with what these numbers mean, they start to tell a story, and you know, the story is the important part. It's not necessarily how the math works. It's more about, if you're able to take a step back and understand what it's saying, that's where this becomes a helpful tool. Anyway, I'll stop there, and you know, if you guys have any questions, I mean, about this, we can talk about the model. We can talk about kind of any granular specific questions you have here, but you know, I'm also happy to answer any questions you might have about what I do. If you guys are interested in finance, like, you know, I'm happy to answer any questions in relation to the field. Yeah, I mean, fire away if you guys have anything. If not, no problem. We can connect later. I'll give you guys you can get my information through Megan. But anything off the top of your guys' head?
I did have one thing when you were going through the very end of the model, like specifically with the IRR. When you're saying it's time sensitive, if a company if they were to invest and it ends up being more like that downside model that we're seeing, is it more harmful for them to hold on to it for longer and see, and hope that it gets better and that more debt gets paid off? Or is it better to just get out in whatever the projected amount of time was?
Yeah, no, that's a really good question. You know, the answer is not that simple. It's kind of, it depends. You know, if the company's doing poorly, it probably means that you're not going to be able to sell it for very much, right? So we're assuming right now that the entry multiple and the exit multiple are the exact same thing, but let's assume that in year 2, for example, EBITDA is down 30%, but you also sell it at a discounted multiple. So you'd sell it at around 6. And so it might make sense to hold on to it for a little bit longer and have the company take a turn, or have the economy take a turn for the better, to sell it then. The other thing too, and this is a little bit more specific, but private equity partners are paid on multiple of money. So they don't necessarily, there's somewhat of a disincentive of selling it immediately so that you juice your IRR. So, but yeah, I mean, it's a good question, and it really depends, because you know, in a struggling economy, or if the company is struggling as well, I mean, you're not going to get as much. You know, you might be able to sell it in 2 or 3 years, but you're not gonna be able to sell it for as much, because your EBITDA is going to be down and your exit multiple is going to be discounted.
Malcolm, can you talk about the circ again? How the model kind of circulates back on itself and how you have to reset it? Can you kind of explain that a little bit more?
Yeah, sure. So the reason why it's circular is because you're basically taking the average debt amount. So you're saying at the very beginning of the period you have X amount of debt, and then you pay that back using free cash flow, and then at the end of the period you have that amount of debt minus free cash flow. So you take the average of the two and then multiply that by the interest rate, and that becomes circular because you're basically subtracting out interest from your free cash flow. So if you think about it, it needs to iterate several times and stop. And sometimes that busts. That's called a model bust, right? And so this is what you have. And so it's basically it's an if function. It says if this circuit breaker is 0, then you have to it gets set immediately to 0. And if it's not, then it takes the mandatory amortization is a function of senior secured debt. It's just something banks like to see. Like it's basically like you need to pay down a certain amount every single year. So you have to, no matter what. But anyway, that's where the circular reference happens. This model is a little different than how I build it. Usually it's an interest, but this works fine as well because this is a component of that circular reference as well. But anyway, Lee, it's basically just when you're paying down debt, the amount, whatever you're paying down that debt with, which is free cash flow, that free cash flow is subtracted out of interest. But then your interest is also calculated with how much debt you have left over. So it's kind of like chicken or the egg, right? It's like if I have $30 million of interest that I'm subtracting out of my free cash flow, but I'm also paying down that debt with the free cash flow that I'm subtracting out my interest with, it's like, okay, where do I start? But Excel has a function where it only iterates like 100 or 1,000 different times, and then it stops. And so that's kind of, and you can set that in the settings, but that's kind of how it handles circular references. And sometimes it's not as good as, I mean, this isn't designed for financial modeling like the program itself. And so you have to create these little devices so that it can handle it. And sometimes it screws up and you just need to set everything to 0. But yeah, I mean, that. Hopefully that makes sense. It's kind of hard to vocalize. It's easier just to see it and then freak out and then realize that it's easy, it's not super hard to fix, but yeah, hopefully that makes sense.
Yeah, it did. Thank you.
Yeah, no problem. Cool, guys. Well, if there's nothing else, then I'll let you go. If anything else pops up, then Megan, feel free to dole out my information, and guys, feel free to reach out with anything. I mean, if you guys are interested in finance, I'm happy to talk more about the industry as a whole. I know a little bit about equity research as well. I think it's a great field to get into. So if you have any questions about that, like, more than happy to answer those. Lee, you're doing something cool after graduation, right? Or you have something lined up, right?
No, I don't have anything lined up right now. Right now, I'm just a biotech equity analyst.
Oh, cool. That's awesome.
Yeah, trying to get something lined up though.
Yeah, and you're a senior this year, or like this coming year?
Yeah, I'll be a senior this year, and I'm graduating early. So.
Oh, cool. Okay. Cool. Yeah, I'm more than happy to talk to you about options, or if you're interested in hearing my opinion on any of this stuff.
Absolutely.
Cool. All right, guys. Well,
Thank
Megan,
you,
unless you have anything
Malcom.
else. Yeah.
We're giving you a virtual applause. Thank you so much for spending your evening with us. And thanks to the three of you, Nick, Mia, and Leah, for joining us. We did record it, so in case you want to remember something that Malcom went through, as soon as that's ready, I'll send that out to you. And Nick, if you want to email the Career Center, I can send you the documents once we have your email address so that you have the model. And yeah, as Malcom said, if you guys are interested, you and some of your colleagues, in a part 2 or learning something else about the model, please reach out to me or the Career Center and we'll work with Malcom to schedule it. But thanks so much for joining us this evening. We appreciate it, and hope to hear from you soon. Have a good evening.
Of course.
Everyone.
Thanks, guys. Bye.
Thank you.
Thank you.